The tariff war isn't over just yet. October 1st, a slew of new tariffs will take effect, including a 100% tariff on some imported drugs, 50% on kitchen cabinets, 30% on upholstered furniture, and 25% on big trucks. On top of that, the Wall Street Journal reporting that President Trump plans to mandate a one-to-one policy for chip makers to manufacture as many chips in the U.S. as they do overseas or face hefty tariffs. Here to break it all down, Sam Stovall, CFRA Research Chief Investment Strategist, and Yahoo Finance Senior Reporters Brooke DiPalma and Inez Ferre. So, Sam, I want to start with you with all the trade headlines that we've been seeing over the past 24 hours. Is the trade war back?
Oh, sure, Ali. It seems like it is back, and with brand new areas to focus on. I think that one of the biggest is with the home furnishing area. So companies like Restoration Hardware, like Wayfair, like Williams-Sonoma, certainly feeling the pressure right now. And questions are, how will things eventually shake out?
And I'm curious, with that potential chip plan down the line from President Trump, on top of the rest of the tariffs that you were just mentioning, is the AI-driven hype enough to offset some of the vulnerabilities that we could see in markets?
Well, I think the AI hype is real. People always talk about equating it to a baseball game. Which inning is it in? Our belief is we're probably still in batting practice. So there is tremendous growth expected for AI, as well as the periphery industries that support AI. And when you're dealing with growth expectations of more than 20% for 2026 for technology versus about 13% for the S&P 500, investors likely are still going to focus on these growth areas.
Yeah, batting practice. And we know a baseball game is 9 innings long, so a lot of runway potentially here.
This is something that the president has talked about before. The timing, perhaps, and the implementation may be a little surprising. Talk us through what we know this morning and kind of your perception of the news.
So I think the big headline, obviously, is this large tariff proposed on pharmaceuticals. But there is quite a large asterisk to that headline, and you have just outlined why. There's this massive loophole for pharmaceutical companies that are breaking ground to build new plants in the United States. That seems to ease the problem there quite a lot from the pharmaceutical companies' perspective. There is also briefly a question about whether this goes on top of a 15% tariff that has already been agreed with the European Union in terms of drug imports. Obviously, the other tariffs like large trucks could have an impact, but we haven't so far seen the tariff regime from the Trump administration having quite the inflationary effects that we would expect. And just one final point, Julie, I would say, politics always plays into this, not only in terms of the big picture, in terms of President Trump's desire to bring manufacturing back here, but also in some of the specifics. The first thing I thought of when I saw this 30% tariff proposed on upholstered furniture products is that the furniture industry had at one point been very important in North Carolina, which is also a very politically important state, both in presidential elections and in Congress.
Yeah, and to your point, that asterisk with the drugs doesn't exist with some of these other products. But I want to get to Brooke for a moment, because it's interesting to see the stock reactions across these various categories that are affected by these newly announced tariffs.
Yeah, first let's kick off with the industry that you were just highlighting, and that's pharmaceutical. What we've heard from so many of these companies, including the likes of Eli Lilly, Johnson & Johnson, as well as Merck, is that we have seen them invest in U.S. manufacturing. And because of that, what we see today, this morning, is this pop in some of the companies' stock, like we had mentioned, because they have said that they're investing in U.S. manufacturing expansion, and that is the loophole needed to go into play. And as you could just see before, we're seeing a bit of a mixed reaction when it comes to furniture stocks. We know that, for example, Williams-Sonoma, Restoration Hardware, those have been under pressure because of the impact of these companies to navigate tariffs. Williams-Sonoma, another one that has been impacted well. These are companies that rely on foreign imports, rely on foreign sourcing to bring to here in the U.S. Now, on the flip side of this, we see Ethan Allen, a company that is based here in the U.S., produces a U.S. furniture manufacturer, popping this morning because of this news that these companies that manufacture here in the U.S. will ultimately be rewarded. They won't have to pay that tariff. And then lastly here is those freight stocks as well. We're seeing a bit of a mixed picture here, certainly as, investors try to assess the risk of overseas freight stocks. You could see Old Dominion popping on this news, XPO, a pretty much flat reaction in pre-market trading. And then another one too, the company behind Peterbilt also jumping on this news. And so investors trying to digest and understand what exactly this means. But what we're seeing here in taking a big picture look back is stock futures are up today. And largely what we saw in the past when these tariff announcements were made is a bit of a downside reaction. And so investors really trying to understand what this means moving forward.
Yes, definitely. And Niall, I want to go back to you because I want to draw a distinction between these announced tariffs and some of the past ones. First of all, there's only a few days until implementation, and the so-called taco trade doesn't really seem to apply here. In other words, the Trump always chickens out. It seems like these are going to go into effect. There's no sort of negotiating them away, right?
It does, although to Brooke's point, I think sometimes one of the reasons why we see a very mild stock market reaction to these announcements is the skepticism about whether they will go into full effect. As you say, there is a very short horizon on these ones, but to get back to the pharmaceutical point, it seems like the impact of that could be quite small. In addition to the issue of drug companies that have manufacturing plants in the US, of course, these new tariffs are to apply to branded pharmaceuticals, in other words, not generic drugs. Generic drugs account for about 90% of the drugs sold in the United States or provided to patients. So I think that's why we're seeing perhaps, or one of the reasons why we're seeing the market taking this very much in stride.
Right. And one of the, there seem to be in the president's drug policy sort of two aims. One, to bring manufacturing back. Two, to lower drug prices. So generic drug prices already tend to be much lower than branded prices.
President Trump goes on social media calling out these new levies, pharmaceuticals and big trucks and furniture. As an economist, Ian, you saw that and what'd you think?
I think it's really the impact we're going to see is going to vary industry by industry. If you go, for example, let's walk through them, trucks. Trucks are largely made in the United States. It's a relatively small percent. I live in North Carolina, so a couple of these industries are very close to North Carolina. We have a Daimler truck plant on the outskirts of Charlotte. So a lot of that relatively muted impact. Furniture, much bigger impact because, as North Carolinians will tell you, where a lot of furniture was made, that largely has left. What's left is really the high end. So, the RHs of the world. There's still some of that made in the U.S., that custom stuff. But it's also something where there's a huge amount of labor that goes into that. And I'm really curious if even at those high tariff levels, if it'll make sense economically to manufacture in the U.S. And that's really the split we've heard from companies. Depends on the industry and the space. Is it that the whole supply chain's overseas and there's a lot of labor intensive stuff, and so even at pretty high tariff levels, they're just going to eat the tariffs? Or is it something where it really makes sense to bring manufacturing back, or you can automate it? In those cases, yeah, we're seeing a lot of stuff pulling back to the US. You saw it in Costco's earnings that highlighted that, pushing more of their sourcing to being domestic.
Why is Trump doing this? It's because he wants more stuff made here. As an economist, do you think of tariffs as an effective policy tool, Ian, to achieve that objective?
I would call it a blunt policy tool. It certainly has its costs you pay with it, but there is a reason to think you can achieve that objective to some degree. Where I'm a little hesitant to say, and I think I've talked to you about this before, but I had a similar conversation literally a couple of weeks ago in upstate New York with a big manufacturer there. I said, look, we're still struggling on the skilled worker side. We can't get enough workers here, and it's a conversation I've had over and over again with manufacturers. So the idea of bringing a ton of manufacturing back here is really challenged by the labor force side. We have just limitations in terms of the number of Americans who are willing to work, particularly in some sort of plant where it's hot, it's difficult working conditions. That's where you really start to struggle to get folks in here. And I think we still see a tight labor market at that lower end. You are seeing some job growth. A lot of it's leisure and hospitality right now. A lot of it's healthcare and social assistance. You pull that apart, a lot of that's actually social assistance. People are missing this story. And what is social assistance when you go even deeper? It's home health aides. It's 200,000 more home health aides we have this year than this time last year. So you have tremendous growth in some of those categories, and those, quite frankly, are really competing. Those Amazon warehouses, all those things are competing directly for those lower end manufacturing workers and pushing up the wages. So that always is the calculus, of course, is what's wages abroad, what's wages at home, and then, of course, what are the tariffs going to cost me?
What did you make of the PCE report today? No surprises there, but
No.
we do seem kind of sticky around this roughly 3% level.
Yeah, do we want to live with 3%, I think was what Goolsbee was kind of implicitly adding. And there was a good question, of course, to Powell the other day that's saying, hey, we've been 2 years away from getting to the 2% inflation target for many years. It's always, the country of tomorrow or whatever. We're the 2 years away from the inflation target. It seems like at this point, as Barkin mentioned, they're really focused on the employment side of the mandate. I expect, we'll probably get another 25-point cut in October. It certainly seems like the messaging is largely aligned there, except for maybe Powell. I expect December as well, and here's why, although I specifically asked Barkin about this, those deferred federal job cuts. That could be, if you read the numbers, potentially you're talking 150,000 federal jobs come off the payrolls in October. That gets printed early November. You have the December meeting may be coming off a jobs report that's really ugly, not too long, not too far previously. So, that's something Barkin says he's going to see through. He's going to try and ignore, much like Powell said, the one-time jump in tariffs. We will see. If I'm the Fed, I'm having a hard time not cutting if I'm seeing, maybe a negative 100,000 jobs report, even if we know that a lot of those are Doge cuts where people are maybe taking early retirement and not really pushing up the unemployment rate in a significant way.
I've had smart people sitting in that very chair, in your chair, who say they should stop trying to stick the landing on a 2% target. They should move to a range. That would make a lot more sense. What do you think?
I think at this point, if you change the inflation target when you aren't near target, when you haven't been achieving it, it more says that you're quitting. And if you listen to the Fed, if you listen to Muslim, for example, gave a good speech back in March on this, talking about it, it is inflation anchoring is a very core part of how they think about inflation, especially in a stagflationary scenario. And that, of course, is the nightmare scenario of any central bank. Now, right now, we're still growing. We're not in a stagflationary scenario, but maybe we're not that far from a stagflationary scenario. And that certainly is the Fed's nightmare scenario to deal with as a central bank. It puts you in a very difficult position. And they're worried they'll have to pull a Volcker and crash the economy to deal with inflation. And that is, no central bank governor wants to double unemployment. The human cost behind that is massive. The life expectancy cost, actually. People die quicker when you spike unemployment. It's not just an economic cost, it is a human cost that's pretty brutal. So I think the Fed doesn't want to unanchor expectations, and that keeps them from, changing the target. And so I think, but I think it's also, they do have two mandates. They do have the employment mandate. Sometimes the critics of the Fed say, hey, we should just cut. We should just keep rates high until inflation hits target. And they're treating it as if there's one target, and right now there's two, and one of them's just, 0.9% above target. That's not that far. They're pretty close, although it's kind of seems stuck there. The other one, we see really low labor turnover right now. We see, unemployment starting to rise in, say, the 18 to 24-year-old population, some of those more marginal populations of new workers. We have this kind of stagnant labor market where people aren't getting hired. So I think they're focusing on that piece, and I agree with that focus.
How did Powell put it? I think he said a challenging situation, Ian. Seems about right. Thank you, sir. Always great to see you.